Hello, I'm Maria Candia, and I am Communications Officer at the IMF. I am pleased to be here today to discuss the Chapter 3 of the IMF's Global Financial Stability Report, titled Investment Funds Fostering the Transition to a Green Economy, which will be published today. And I am delighted to be joined by the lead authors of the chapter, Jérôme Vandenbussche, Deputy Division Chief of the IMF's Monetary and Capital Markets Department, and Felix Suntheim, who's a financial sector expert of the same department. So Felix, let me start by asking you a question that will offer our viewers the key topics included in this report. You're right that the sustainable investment fund sector can be an important driver of the global transition to a green economy. What exactly are sustainable investment funds and how can they foster the transition?
Let me maybe start first with a brief motivation of the chapter. So we know that to limit global warming to acceptable levels, we need a deep reduction in greenhouse gas emissions. And that really requires the mobilization of private finance on a very large scale. While carbon pricing remains the most effective tool to achieve that, we likely need a broader policy mix. And here the investment fund sector, and specifically the sustainable fund sector, could play a crucial role. And that's really what the chapter is about. So what are sustainable funds? Different to conventional funds, sustainable funds have sustainability objectives in addition to their financial objective. And within the broad class of sustainable funds, there's a lot of differentiation. So some funds are broadly focused on sustainability, others are more narrowly focused on the environment or on climate change mitigation specifically. And then there are also, of course, the conventional investment funds, which are also increasingly factoring sustainability consideration into their investment process. But for them, sustainability outcomes are not necessarily part of their investment objectives. And that's where we draw the line between sustainable funds and conventional funds. Now, how can sustainable funds support the transition to a green economy? In general, they can affect the corporate sector through two mechanisms. First, by increasing the supply of capital to firms, that pushes then up the prices of securities, and it makes it easier for firms, specifically green firms in this instance, to raise capital and to finance their projects. And then second, through stewardship. So proxy voting and other forms of engagement allow funds to influence the behavior of firms and push for the transition-aligned corporate policies. An example here would be, for example, the recent election of climate activist investors onto the board of ExxonMobil. And what the chapter does is it looks at the effectiveness of these two mechanisms. So increasing the supply of capital and climate stewardship. And in fact, we do see some evidence that these two channels are working. So we see that funds, especially sustainable funds, have stepped up their climate stewardship. They've become increasingly supportive of climate-related shareholder resolutions. And we know that these resolutions can affect firm behavior. And second, we find that sustainable funds, fund flows into sustainable funds, they encourage the issuance volumes of bonds and equities, specifically of firms that are more sustainable. So these are the two mechanisms that we investigate in the chapter and that we find to be working.
Felix, let me ask you a follow-up question. Is the sustainable investment fund sector big enough to really make a difference?
So I think the analysis in our chapter, it suggests that it may not be big enough. So even though total assets under management of sustainable investment funds have really been growing rapidly, so they've basically doubled over the last 4 years and reached, I think, 3.6 trillion in 2020. They still constitute only a very small fraction of the overall investment fund sector. And climate-themed funds in particular, so those funds with a specific focus on climate change, they accounted only for 130 billion of that total. In our analysis, we then see that while sustainable funds encourage the security issuance of firms with a sustainability focus, we see that this result does not hold for firms that are specifically focused on the climate transition. And here, one reason may be that the sustainable fund sector is actually too small and that it's not focused enough on climate.
Thanks, Felix. Jérôme, a question for you. What metrics do you use to measure alignment with the transition? Are people right to worry about greenwashing?
In addition to the specific label, a common way to obtain sustainability information about an investment fund is through scores related to environmental, social, and governance considerations. An important issue is that the underlying data at the firm level suffer from deficiencies in terms of coverage, in terms of comparability. And we run a survey for the chapter of asset managers and portfolio managers. And these asset managers and portfolio managers often cite data quality issues and multiple disclosure standards and the lack of a globally agreed taxonomy as obstacles to properly measuring the risks, the opportunities, and also the impact related to sustainability and the transition to a green economy. So what we do in the chapter is to tread as carefully as possible, and we construct two key scores to summarize a fund's exposure to a transition. First, a transition opportunity score, and second, a carbon intensity score. The transition opportunity score is a kind of composite measure that is based on a range of metrics, such as a company's carbon reduction efforts, the development of products or technologies related to renewable energy, or the firm's broader environmental research and development. By contrast, the carbon intensity score simply measures the firm's greenhouse gas emissions relative to its revenue. When we look at the global investment fund sector in the aggregate, a transition opportunity has essentially remained stable over time, over the past 10 years. While average carbon intensity has remained stable or declined slightly, roughly in line with the decline in carbon intensity in the economy as a whole. As expected, we find that investment funds with a climate label hold securities with a higher transition opportunity score and than their conventional peers. And perhaps surprisingly, we find that the carbon intensity of their portfolio is also higher than that of conventional funds. So we believe that part of the explanation is that these climate-focused funds tend to invest in firms that are more likely to significantly reduce their emission intensity during the transition, or they will facilitate the reduction of emissions in other sectors of the economy, rather than those firms with already low levels of emissions. So we agree that greenwashing in the asset management industry is a concern and needs to be taken seriously. We think it's really important that fund labels fairly represent funds' investment objectives. In fact, in the chapter, we find that flows into funds have been increasingly sensitive to sustainable and environmental labels in recent years. But as Felix just mentioned, it does look like the record of sustainable funds in terms of climate stewardship and in terms of supporting the provision of capital to firms with higher sustainability ratings is better than that of their conventional counterparts. So we think that's encouraging.
Now, Felix, what can policymakers do to support the growth of sustainable finance and address these greenwashing concerns?
Thank you, Maria. So in the chapter, we argued that for the sustainable fund sector to grow and to play its role in driving the transition, what policymakers should do is to strengthen what we call the global climate information architecture that consists of data, disclosures, and sustainable finance classifications. Strengthening these elements that would bring transparency, it would enhance market confidence, and would facilitate proper regulatory oversight, which then in turn would enable regulators to prevent greenwashing. It would of course also help investors to manage risks and allocate capital efficiently. Now, once those elements in place, one could then consider additional tools to help channel savings into sustainable funds. So these would be, for example, financial incentives for investments in climate-oriented funds. It's important to note, of course, that those tools should be seen as complements, not substitutes to other climate change mitigation measures, such as, for example, carbon taxes.
Thank you, Felix. And now going to Jérôme, the chapter argues that the transition to a green economy also presents financial stability risks. Could you speak about those?
Sure. So, the investment fund sector as a whole has also sizable exposures to industries with high transitions, sensitivity, such as energy, utilities, transportation, manufacturing, etc. So the transition also has financial stability implications for the investment fund sector and for the financial sector more generally. So, when a large and unexpected transition risk shock, for example, sudden change in climate policy occurs, we could see risk to financial stability emerge. If the shock leads to a significant reassessment of risk by investors, we could observe large outflows from funds, which could lead to fire sales and trigger a further drop in asset value. So what we do in the chapter is to examine the impact of large climate news events on the investment fund sector over the past 10 to 12 years. And we focus specifically on three dimensions: fund returns, fund flows, and changes in fund portfolio composition. And we find that the effects of these climate news events has been small in all three dimensions. So this suggests that the major climate change shocks, climate change events in the past have not had a huge impact on investors' perceptions of the speed of transition so far. Of course, that does not imply that a sudden transition risk shock would not be disruptive in the future.
And Jérôme, what can be done to reduce those risks?
Felix just spoke about the importance of improving the climate information architecture, and such improvements would also clearly have a beneficial impact on risk management and therefore on financial stability risk. In addition, we believe there are two things that policymakers can do. First, they can implement a climate policy that is consistent with an orderly transition, and that would avoid a sudden repricing and associated liquidity shocks. And second, they could use scenario analysis and stress testing of the investment fund sector and of the financial sector more broadly to understand and quantify risk from climate change. A growing number of supervisors has started employing these tools in recent months in various segments of the financial sector or in the financial sector as a whole. And the fund is increasingly including climate stress tests and scenario analysis in the context of the financial sector assessment program, which is carried out jointly with the World Bank. Finally, coming back to sustainable finance, there's a good news. The good news is that sustainable investors are likely to bring financial stability benefits. Our analysis in the chapter indicates that these investors are less sensitive to short-term financial returns, and therefore they could act as a stabilizing force.
Well, thank you so much, Jérôme and Felix. Thank you for the very comprehensive discussion, and thank you for taking these questions. Thanks, everybody. Have a good day.